Friends, in this video for I Thought Wealth, I am going to talk to you on the topic commodity stocks. Are we being too pessimistic? The past few weeks have seen a spectacular collapse in commodity stocks. Metals were at the forefront of this correction, but the impact has spread to several other commodity related businesses too. The movement in commodity prices affects sentiment adversely in commodity stocks. If the raw material prices move up too much, then markets start worrying whether companies will be able to pass on that hike. If finished product price comes down, market worries whether companies will make profits at all. If both fall, then all hell will break loose. That is what we saw in several metal stocks. On the one side, input costs went up. On the other side, selling prices are continuously coming down. The fear which a policy change creates in commodity stocks is usually far more impactful than how policy affects other sectors. The reason is that in our minds, commodities are deeply etched as volatile places to invest in. And the last 15 years have not been easy for commodity businesses. But one must remember a few important pointers. First, Indian companies have scaled up significantly over the last 15 years. The size of a commodity company today in India is several times what it was in the last 2008 bull run in commodities. So, scale is much bigger. Companies have much less leverage than they had in 2008. Capacities are being created at a pace which is not so fast to burden companies. So, they are creating capacities just before demand expands to fulfill that capacity. Also, markets are becoming more localized. They are not as globalized as they were in 2008. The reason is that countries want to protect their local industry. They don't want to import what can be produced locally, and they also want local production to grow so that resources can be used, and that will significantly contribute to the economic growth of each country. Also, bilateral relationships are becoming stronger by the day. Companies are going and buying assets in countries which are resource rich and using those resources to produce more. Traditionally, Indian commodity players have been more profitable than commodity players outside. There are a lot of reasons. One, as I said, is that the markets are reasonably closed in several commodities. The second is that we have resource integration. So, you have a very strong value chain and integration which ensures that companies are able to make more profits. Chinese steel makers have EBITDA margins which are single digit, between 5 and 7%, whereas a company like Tata Steel, which is integrated, has significantly higher margins. If Indian commodity companies are able to scale up without taking on too much leverage, then these companies could do much better than what markets expect of them. Local factors or near-term policy changes have rattled the stock market, but one can safely assume that when these are reversed, the stock market may actually overreact to that news as well. So, on both sides, both on the side of fear and greed, stock markets tend to overreact when it comes to commodities. The news flows are also like that. One fine morning you wake up to hear that Chinese prices of certain commodities are up significantly, and if you hear that news for 2 or 3 days consecutively, then everybody is going to jump into those commodity producers. So, you see a sharp bump. Similarly, when prices fall, you see a sharp cut. The opportunity lies in understanding one thing very clearly. after darkness there will be dawn. So whenever you have extreme pessimism, you can rest assured that over a period of time, you will see high optimism also return. But that is not being sensed by the market right now because the mood is very pessimistic and nobody wants to stick his neck out. With performing against the benchmark becoming increasingly difficult, institutional investors don't want to take on this kind of volatility. That is primarily the reason why metal stocks are more volatile in India, because when there is selling by one set of investors, you don't have institutional investors on the other side. Even those institutional investors who tend to buy these stocks in corrections trade out very quickly, keeping these stocks constantly under selling pressure. Not to forget, government policy changes like the recent export tax to combat inflation have been great dampeners of sentiment. But one should look at the longer, bigger picture. The longer term picture is very clear. We will become more and more self-reliant in production of metals. We will integrate our resources much better. We will produce more of the raw materials than we are producing now. This naturally will give a very solid value chain for producers of commodities, and we have a market and we have an economy which can absorb whatever we make. We only need to export a little bit of surplus so that the domestic markets remain reasonably stable and you don't have a glut. We also have an option of becoming an exporter economy in metals where we produce only to export, but changes like the recent export tax will be a strong dampener and companies will hesitate to put capital and captive capacities dedicated to exports. So that is something which government has to address in right earnest in the coming quarters. If the government is able to give better visibility of how policy will play out, then we could have captive export capacity in metals. We also will see the cost structure stabilize, and when all this happens, I believe the pessimism will gradually run down. Having said that, the extreme pessimism we have seen in recent weeks is definitely softening, and the coming weeks will see markets take a more measured and balanced view of commodity companies. Remember, India has enough demand for these commodities and we only have to manage the surplus production through tactical export. So if we are able to do that, then we should be fine. The export tax which we have put now on a lot of metals is mainly to manage inflation. If inflation data softens and we see a very clear sufficiency in the domestic market, then exporting a little bit should be once again allowed, and that should change the perspective on several commodities. So in summation, I think the pessimism is overdone. We are having globally competitive producers. Integration is only improving. The raw material production is only going to be scaled up so that we are completely self-sufficient or more and more self-sufficient with passing time. We will see demand grow with more investments and more assets being created. And with exports of downstream products also going up, the demand for metals is going to be robust. With Russia and Ukraine out of the global market, we should be able to take some bit of that market share. Overall, I am not pessimistic, but I am not gung-ho either. But one thing that I remember from my own investment experience, when pessimism is very high on the street, I would like to be a contrarian. Thank you for watching this video.